Sarah and Tom are drowning in debt, $760,000 of it. They're both in their early 30s, making $230,000 a year together, and they can barely sleep at night. Every month, they send thousands to creditors and watch the balances barely move. They thought education and hard work would set them free. Instead, they're trapped in a financial prison of their own making, wondering if they'll ever escape. What I'm about to share is a painfully true story that we should learn from. This is MindSnack Finance, bite-sized lessons with lasting value. We've changed their names to protect their privacy, but the crucial thing is they're buried under debt they can't see a way out of, convinced bankruptcy is their only option, paralyzed by shame and fear. But there's another way, a harder way, a way that requires brutal honesty, extreme discipline, and years of sacrifice. And today, we're going to lay out exactly how Sarah and Tom, and anyone in a similar situation, can dig themselves out of debt without destroying their financial future through bankruptcy. This isn't going to be comfortable, but it might just save your life. Let's break it down. First, let's look at exactly what Sarah and Tom are dealing with, because you can't solve a problem you don't fully understand. Total debt, $760,000. Let that number sink in, $750,000. Here's how it breaks down. $210,000 in mortgage debt. This is actually their best debt. It's secured against an asset that typically appreciates. It has a relatively low interest rate, probably 3% to 7% depending on when they bought, and it's tax deductible in many cases. Mortgage debt isn't the enemy here. It's the foundation they'll build on. $335,000 in student loans from advanced degrees. This is the biggest single chunk. Graduate degrees, professional certifications, multiple years of higher education. They invested in themselves expecting a massive return. And while their $230,000 of combined income suggests those degrees are working, the debt load is crushing. Student loans typically carry 4% to 8% interest rates, or higher if those are private loans. On $335,000, that's $13,000 to $27,000 per year just in interest before they touch the principal. $136,000 in credit card debt. This is where things get ugly. Credit cards typically carry 18% to 25% APR. Let's assume 20% average. That means they are paying roughly $27,000 per year in interest alone on their credit cards, and it's doing nothing but keeping them on the hamster wheel. And it gets worse. They enrolled in a debt relief program, but the company has made no progress negotiating with card issuers. Translation: they're paying fees to a company that's doing nothing while interest continues to compound. They're bleeding money in two directions: $44,000 in personal loans. These typically carry 8% to 15% interest, whether it's consolidation loans, family loans, or unsecured personal loans. This is another monthly payment draining their cash flow. $35,000 in car loans. Two cars, probably financed at 4% to 7% interest. Necessary for getting to work, but depreciating assets financed with debt. Every month those cars are worth less while they still owe money. Now here's the question that matters. How did two intelligent, educated people earning $230,000 a year get here? They made really poor financial decisions thinking, we should be able to pay it down as we go. But it doesn't happen. This is the assumption that destroys lives. We make good money, we'll handle it, we'll pay it off eventually. But eventually never comes. Because as income rises, so does lifestyle. The nicer apartment becomes a house. The used car becomes a new car. The occasional dinner out becomes 3 times a week. The debt doesn't shrink, it grows. And suddenly you're making 6 figures and living paycheck to paycheck, wondering what the hell happened. So why not just file bankruptcy and start over? It seems like the easy way out, right? Here's why bankruptcy should be avoided. First, student loans typically can't be discharged in bankruptcy. That $335,000. It's staying with them regardless. Bankruptcy won't touch it unless they can prove undue hardship, which is an incredibly high legal bar. So they destroy their credit, lose assets, and still have the biggest chunk of debt following them. Second, Bankruptcy devastates your credit for 7 to 10 years. Chapter 7 stays on your credit report for 10 years. Chapter 13 for 7 years. During that time, getting approved for a mortgage, car loan, or even an apartment rental becomes exponentially harder. Interest rates on any credit they do get will be punishing. Some employers check credit reports. Some professional licenses require good financial standing. The consequences ripple far beyond just the debt itself. Third, they'd likely lose assets. In a Chapter 7 bankruptcy, non-exempt assets get liquidated to pay creditors. Depending on their state's exemption laws, they could lose their home equity, retirement accounts above certain limits, even personal property. Chapter 13 avoids liquidation but requires a 3 to 5 year repayment plan, supervised by the court. Fourth, the psychological impact is real. Bankruptcy feels like failure. It carries stigma. And while sometimes it's the right choice for people genuinely unable to pay, Sarah and Tom make $230,000 a year. They have the income to solve this. Bankruptcy would be choosing the easy way out instead of taking responsibility for their choices. Finally, bankruptcy doesn't fix the behavior that created the debt. If they file bankruptcy without changing their financial habits, they'll just rack up new debt afterward. The problem isn't the debt. The problem is the decision-making that created it. So bankruptcy is off the table, which means there's only one option left. They need to dig themselves out the hard way. Before we get to the tactical plan, Sarah and Tom need to hear something uncomfortable. Their lifestyle is over. The version of themselves that got them into this mess, the people who thought they could have everything now and pay for it later, that version dies today. If they want to get out of this hole, they need to become different people with different priorities and radically different spending habits. Here's what that means in practice. No more new debt. Period. Credit cards get frozen in a block of ice. Car loans end when these cars are paid off. No personal loans. If they can't pay cash, they don't buy it. This is non-negotiable. Every dollar gets a job. They need a zero-based budget where every single dollar is allocated before the month begins. They're not hoping money is left over for debt payments. They're planning for it, prioritizing it, and living on what remains. Lifestyle deflation becomes the mission. They're making $230,000 but need to live like they make $100,000 or less if possible. That extra $130,000 goes entirely to debt. This means a smaller, cheaper living situation. One car instead of two if possible, or driving these into the ground. No vacations. Not eating out for months to come. Free entertainment. Essential purchases only. This is going to suck. Their friends will be living it up. Social media will show everyone else traveling, upgrading, enjoying life. Sarah and Tom will be saying no to everything while watching money disappear into debt payments. But here's the reality. They're not actually giving anything up. They're getting their lives back. Right now, they're slaves to their creditors. They don't own their income. Their debt does. All right, now let's get tactical. Here's the step-by-step plan for Sarah and Tom to eliminate $760,000 in debt without bankruptcy. Step 1. Cancel the debt relief program. First things first. Cut the debt relief company immediately. They're paying fees for zero results while interest compounds. Those fees need to go straight to debt repayment instead. They should attempt to negotiate lower interest rates on credit cards directly. Call each issuer, explain the situation, ask for a rate reduction. Some will say no. Some might say yes. Every percentage point matters. If they can get credit cards down to 15% average, they save thousands per year. They should not negotiate settlements or skip payments. This destroys credit and has tax consequences. But negotiating better rates is fair game. Step 2. Build a minimal emergency fund. Before aggressively paying debt, they need $2,000 to $3,000 in an emergency fund. Just enough to handle minor emergencies without going further into debt. An HVAC repair shouldn't create new credit card debt while they're trying to eliminate old debt. Step 3. List all debts with interest rates and minimum monthly payments. This creates the roadmap. Based on what we know, it might look like this. Mortgage. $210,000 at 4% $1,000, excluding property taxes. Student loans, $335,000 at 6% $2,300. Credit card debt, $136,000 at 20%, $2,700. Personal loan, $44,000 at 10%, $700. Car loans, $35,000 at 5%, $600. Total minimum monthly debt payments, approximately $7,300. Step 4. Choose a debt payoff strategy. Avalanche versus snowball. The avalanche method saves the most money and interest. The snowball method is psychologically powerful. Quick wins build momentum. My recommendation for their situation is modified avalanche. They should use the avalanche method, but with one exception. Knock out the car loans first, even though they're not the highest interest rate. Here's why. Car loans are relatively small at $35,000. They can eliminate these in a few months with aggressive payment, which creates $600 a month in freed-up cash flow and psychological momentum. Once cars are paid off, that $600 plus whatever extra they were throwing at them goes straight to credit cards. The credit card debt at 20% interest is an emergency. They're paying around $27,000 per year in interest alone. Every month, the wait costs them $2,300 in interest that does nothing but keep them trapped. Step 5. Execute with extreme focus. Here's what the plan looks like in action, assuming no additional income or bonuses go toward the debt. Phase 1, months 1 to 12. Eliminate car loans. Budget to live on $7,000 a month for everything except debt minimums. Throw approximately $3,000 a month extra at car loans. Car loans paid off in 12 months, freeing up $600 a month. Phase 2, months 13 to 40. Eliminate credit card debt. Now they have $3,000 plus $600 equal $3,600 a month to throw at credit cards. Credit card debt of $136,000 takes roughly 27 months to eliminate at this rate. Once done, they free up $12,700 a month from minimum payments, plus the $3,600 they were throwing at it equals $6,300 a month available. Phase 3, months 41 to 48. Eliminate personal loans. Throw $6,300 a month at $44,000 personal loan debt. Eliminate it in approximately 7 months. Frees up another $700 a month minimum payment. Phase 4, months 49 to 97. Attack student loans. Now they have $6,300 plus $700 equals $7,000 a month to throw at student loans. $335,000 at $7,000 a month takes approximately 48 months. By month 98, roughly 8 years from start, student loans are gone. At this point, they're down to just to whatever is left in the mortgage. They can pay minimums and focus on wealth building, or aggressively pay it down. With massive free cash flow, they could eliminate the mortgage in 2 to 3 years if desired. Total timeline: approximately 8 to 10 years to be completely debt-free except possibly mortgage. Yes, that's a long time. Yes, it's brutal, but here's the alternative. If they keep making minimum payments with no strategy, the credit card debt alone will take 20 plus years to pay off and cost them over $200,000 in interest. The student loans will take 25 plus years. They'll be in their 60s before they're debt-free. Step 6. Track and celebrate progress. They need to track their debt payoff visually. A spreadsheet showing declining balances, total debt trending down, net worth improving. Every time they pay off a debt, they celebrate. Progress compounds psychologically. Let's be brutally honest about what this plan requires. 1. This will take 8 to 10 years. There's no quick fix, no magic bullet. Just years of grinding, sacrificing, and staying disciplined while everyone around them appears to have it easier. 2. They will miss out on things. 3. Their marriage will be tested. 4. They might face emergencies that could derail progress. Medical bills, job loss, home repairs, you name it. Life doesn't pause for debt payoff. They need to build that emergency fund bigger as they progress and expect setbacks. But here's what they get if they stick with it. 1. By their early 40s, Sarah and Tom could be completely debt-free with a paid-off house. No student loans, no car payments, nothing. 2. Their entire income becomes theirs to invest, save, travel, and build wealth with. 3. They go from slaves to their debt to masters of their financial destiny. That's the prize. That's what makes the sacrifice worth it.